Hey friends, Lucian here with the Bullish Bears team. This video is going to be about how to read an options chain. So you'll see right now, this is the Thinkorswim platform that I'm showing you. Every brokerage account's a little bit different, but they all have their own version of an options chain. So let's go right over here and you'll see if I click on the trade tab over here, you're gonna see if I collapse this right over here, a bunch of different dates, right? So these are expiration dates. So the thing with options is each options contract has an options expiration date. So options expire. So when you're trading shares, obviously, you can hold shares of a stock for as long as you want. With options, not the case. They all have an expiration date. So you'll see these dates all down over here. The gray areas are monthly expirations, and then you'll see these ones that say weekly expirations. So basically, you can do monthly or weekly options contracts. Weekly are more of the the short-term expirations. There's people that do long-term trading with options, and there's other people that do day trading options, short-term swing trading. So you'll see right over here dates. So every options contract has a date to expiration, and then you'll see the number down over here. This is the number of days until expiration. The number 100 is just each options contract is the equivalent of 100 shares or controlling 100 shares. So when you're buying or selling an options contract, you basically need to make a decision on what you're going to do before the end of your expiration date. So this is where the concept of where, options are risky, people will say. Again, any trading style is risky if you don't know what you're doing. If you're just trying to trade blind, if you're just buying a naked call or put, not knowing what you're doing, then yeah, it's a easy way to lose money if you're just randomly trading. But if you understand, why you would take a specific options trade strategy, what you're looking to do with it, and have a plan, it's not risky, right? So that's where cutting your losses, having proper risk management is really important with any trading style. So again, these are the expiration dates, very, very important. Time, right? So time with options gives you, it gives you more time. So the more time you have in your favor, the better. However, if you're an options buyer, every day that goes by, there's what they call extrinsic value or time value. So the more an options contract goes in your favor, the more time is on your side and the more the options contract goes up. The more the option goes against you, the more time value you lose, and it sucks time value out of your option, and that's where you could start to lose more money very quickly. So that's why when you're buying naked calls and puts, you want to make sure the direction you get it right. So when you come up here, you can change filters up here. So you can add different filters, expiration types, days to expiration, stuff like that. I don't have any of the filters on. You can come up here, you can change up here. These are all the different order types. I'm not going to go over all the different order types in here. I'm just going to explain what to look for in an options chain. But this, again, this tells you all the different orders. Single is just buying a naked call and put, but vertical spreads, or that's where you look at credit spread, debit spreads, stuff like that. So now when you go over to layout over here, this is where you can customize and look at the different columns, right? So I'm going to show you in a moment just some columns that I have set up. But this is where you can kind of go in and see what's in here, and you can go in and customize it over here. You'll see right here when I open up right in here, you'll see all the different columns I have over here. So you can kind of come up here, change it, and customize your layout. You can add or remove columns over in here. Again, that's totally whatever. Everybody has a different, depending on your trading style with options, that's going to determine what kind of columns you put over there. So at the top of this options chain, you'll see over here to the left side is calls, to the right side is puts. So going back to being an options buyer, if you are buying a call, you're bullish on the stock, you would look over here, you would look to the buying side, right? If you're buying a put, which means you're bearish on the stock, you come over to the left side of the chart and you would look at the put side, right? So when you come down here, you'll see this kind of purple and black area down here. Anything in the purple up, anything that you see that's purple going this way, these are what they call in the money calls, right? So these are in the money, and the black area is out of the money. And same thing on the put side, it's just a little bit reverse. Over here, purple over here is in the money. Black areas, you'll see in the background here, is out of the money. So what does in the money and out of the money mean? Well, you'll see these strike prices right here. When you see Apple up here, this is, the market is open. You'll see the price of Apple, as shares kind of moving quickly over here, right? So you'll see these prices on the call side are all below the price of Apple. So that means they're going to be more expensive. So when you buy an options contract, remember, you can buy and sell the options contract itself, or you can exercise the options contract as well. So that's for owning shares of the actual stock. So what happens is the more in the money you go, the more odds in your favor of it expiring in your favor or in the money. You want, ideally, an options contract to expire in the money if you're an options buyer. So that's where you look over here and you'll see these columns right here. This says out of the money. So this says probability out of the money. So if I change this over here and I customize it and I remove probability out of the money and just put in probability in the money, I can put this column over here, add it right here, and you'll see right over here probability of in the money. So as you'll see, the percentages up here, this is the probability that you'll see. Let's just go out a month or so. We'll go out right over here. You'll see the probabilities over here increase the more in the money that I go. That's why you'll see the price of the options contract is much higher, because the odds are more in my favor that if I'm being an options buyer, right? So if I'm just buying a call, you'll see that, the higher I go up this chain, the more probability that that is going to expire in the money, and then I'll succeed on that trade. So that's where you can see the price goes way higher the deeper in the money that you go. Now remember, each options contract is the equivalent of 100 shares. So you'll see right here when I'm, if I bought it at 605, that would be 605 times 100. So that would be $605 for that options contract, and that controls 100 shares of Apple. But you'll see if I go up higher and let's say look at, a 92%, if I look at 3975 times 100, you'll see that's almost 4,000. So you'll see the reason why it's 4,000 compared to 600 is the odds are way more in my favor that trade is going to go in my favor. So in the money as an options buyer puts the odds more in your favor. Remember, you don't want to just buy naked calls and puts without knowing your strategy and what you're doing. I'm just showing you just how you put the statistics or the odds more in your favor, what to look for. But the reason why it's more expensive is the odds are more in your favor. Now, this is where a lot of people or new traders end up failing, is because, a lot of new traders, they might have less than 5 or 10,000 in their brokerage account. So they don't want to go putting $4,000 into one trade. So they're like, well, let me buy the cheaper ones, right? Let me go out of the money. So they look at these black areas and they're like, oh, wow, I can buy Apple for, 62, let me look over here, 62 cents. Okay, perfect. So let me just do 0.62 times 100. Cool. Oh, that's only 62 bucks to get into Apple. I'm going to buy that one. But the problem is they're not realizing their odds of this trade, so they're buying, right? So you want that options contract as a buyer to be in the money at expiration, not out of the money. But this is showing you right here that you would only have a basically less than 10% chance. So you have a 90% chance of failure. And that's where, great, it's cheaper at $62, but this is where you're buying and you're basically just giving money to somebody else because the odds are not in your favor. It's basically gambling, right? So, but the problem is that's what most new traders do with options. They come in, they buy the cheapest option, then they blow up their accounts, or they say, oh, options are risky. Well, they're risky because they didn't do the right option strategy. They're buying the cheapest options, not realizing they're out of the money and the odds are not in their favor. Now, another thing to be aware of is probability of touch. So there's probability of in the money and also probability of touch. So you could have, let's say, a 90% chance that it's going to expire in the money, but a 14 or 15% chance that it could touch your strike price. You can see over here, these are all the different strike prices. So obviously right down here, you can see if you bought at $95, Apple, you're paying the premium on top of that over in here of $25. So 95 plus 25, 95 plus 25 is $120. So the reason, you have those odds in your success is 90% chance is that Apple only has to move about $1 within 36 days, right? So how you figure that out is basically you take the strike price, whatever your strike price that you're looking to get into, add the price of the premium that you're paying, and if price is above that, that would be in the money at expiration. So as we go lower, let's just say right down over here, 115. So 115 strike, if I add $7.35 to it, that would be 115 plus 735. That means Apple would have to be, has to move up to $122. That's a $3 move, right? So Apple needs to move $3 in this scenario down here in your favor. So it needs to go up $3 compared to what I was just showing you about $1 or less. So that's why your odds are more in your favor up here, because the move has to be less in your favor. And that's why you're paying more for the options contract. So again, each one of these prices, you just multiply times 100. So these are all the equivalent of one options contract. You multiply it times 100, and that's the price that you pay for the options contract. And then whatever that price is, you add it on top of your strike over here, and that's the amount that price needs to move. So that's where if you go down over here, 62 cents, well, that means Apple has to go $135.62, right? 135 plus 62. Well, if you look over here, Apple's at $119. That means Apple's got to move, like $16 in 36 days. So the move has to be greater. So this is where, again, there's times and places to buy out of the money options contracts. But if you're brand new to options and you're just buying naked calls and puts, you have to be seriously careful buying just out of the money over here. Just because they're cheaper and you can afford them, look over here, the odds of your success are much lower. So again, much more in your favor over here, but just because they're in your favor doesn't mean you buy them as well. Because you can get shook out, especially down in these areas right here. You could have a 75% chance of succeeding on that trade, but 50% of the time, price might fall down to your strike and shake you out and be like, oh man, this is going to go against me, and it shakes you out. It just touches your strike, and then many times it goes the other way, and it'll shake you out to sell your options contract. There are a lot of things. I'm not going to explain them all in this video. We explain it in our courses. The options Greeks. There are several Greeks that make up options contracts other than, time value. So there's intrinsic value, extrinsic value, lots of other parts or components that make up an options contract, and it's, again, you need time to be on your side, but there's other things. So like the price will move with an options contract. You'll see right here, delta. Delta, this is the amount right here I'm not going to go into all the Greeks, but I want to bring your highlight delta for a moment. This number right here is the amount up or down that the options contract moves per $1 move. So if Apple moves up $1 and you're looking down over here, that means the options contract would move up 58 cents, the delta portion of it. If the options contract goes down $1, you lose 58 cents, right? So, again, if you're buying 5 options contracts, that's where, it's 5 times 100, that'd be controlling 500 shares. So again, in this scenario, 590 times 5 times 100, right? So that'd be $2,900, right? And if you take a times, 58 cents or 58 cents times 5, just that portion, 58 cents times 5, if Apple, times 100, so if Apple moved up $1, that options contract can move up about $290. Again, I'm giving you a rough estimate. There's other Greeks that make up the components here. But if Apple goes down $1, you can lose $290, right? So this is where, when you're putting things together, you look at the strike, the price that you pay over here, look and add that up, and that's where you need price to move. So you want, again, you see the deeper in the money that you go, the more it's easier for price. It's not far away from price. The farther out of the money that you go, it's much more unrealistic that it's going to go your way, and that's why you lose your money. And that's why, as an option buyer, when you're buying out of the money, you're basically just giving your money to the option seller. So when you're looking at strike prices, you can come up here and you can kind of change things around. This shows all the strikes. You can filter it if that's too many and do less, depending on what your strategy is. You'll see, again, all the different ones here. The larger, like very larger, cap stocks will give you more strikes to trade. You won't always see weekly contracts if it's not like a really highly traded, highly liquid, stock. Then you might not see weekly options contract because it's not traded as much. That doesn't mean don't trade them. Just be aware of that. Also, too, you want to look at, these spreads. You want to have, ideally, a tight bid-ask spread. Again, Apple, Netflix, Google, big name companies typically have a good size, like, bid-ask spread. So you can see tight, 5 cents, 10 cents. That's what you like to see. You want to avoid stuff that has 50-cent spread, $1 spread, $2, $5 spreads. So that's where, again, you might find a stock that's $15 and has super cheap options contracts. So maybe in the money over here, instead of it being $11, it might be $1. So you're like, oh, I'll buy that because that's only going to cost me, whatever, $100 to get in rather than $1,000. But you might have a $2 wide bid-ask spread, and it's going to be, that's not something you necessarily want to trade. Right? So another thing you want to look for, very important, is open interest over here. These are the amount of outstanding contracts that are still in play. You ideally want to see high open interest in that column because you want to trade highly liquid stocks, right? And you want to trade highly liquid options contracts because you want to be able to get in and out of the contract. So you'll see, especially with the higher, like more large cap popular stocks, lots of open interest. Minimum, you want to see at least a minimum of 100, but ideally you'd like to see 1,000 or more. When you see all of this, this is highly liquid. Doesn't mean you buy it. It just means that it's highly traded. If you see stuff that doesn't, on a random stock and you're seeing stuff like 22, 37, 61, that's where you want to avoid that, right? Again, doesn't mean you don't buy it here. That's, I'm saying just like some random stock. You want to see a lot of open interest and then pay attention to volume. So open interest is the amount of outstanding options contracts. So again, that's, people buying, in those contracts so that they're highly liquid. But then if you see stuff like, lots of volume coming in that day, there's reasons why people are getting in, right? That's a whole other there's reasons for why people are buying them, but pay attention because if you see lots of volume coming in, as well as open interest, people might be anticipating a big move. Remember, big money comes in and they buy. They can't hide these things, right? So if somebody's buying and putting in millions of dollars or taking huge trades on Apple, be aware of that. If you see this, don't buy it just because you see it. But if you see lots of open interest, like thousands or something very unusual, and you see, unusual volume and then like high open interest, pay attention to that stuff. So very important. So open interest, whenever you enter into an options contract, you want to ideally see high open interest. I personally like to see at least 1,000 open interest or more. It doesn't always have to be lots of volume, but just pay attention. If you see huge volume, that might be something, to pay attention to. So again, lots of there's Greeks and other components that make up an options contract. I want to kind of keep this simple. Overall, this is kind of like a highlighted video on how an options chain works. So basically you look over here and you see the expiration date over here for when the options contract expires, the number of days to expiration. You'll see these gray areas are monthly expiration, the yellow are weeklies. Those weekly contracts, they're obviously cheaper because there's less time to expiration. Those are people that are typically kind of day trading them or doing short-term swing trades. So when you open this up again, you can kind of customize your columns to the way that you like. Right up over in here, you can customize. Again, just showing delta. This is an idea of, again, per $1 move. So if Apple moves up $1, the delta would move up 79 cents. If it goes down, so that'd be a $79 move because 79 cents times 100. If it goes down $1, that options contract would lose $79 worth of value. You want to pay attention to high open interest, at least 1,000 or more. Look for huge volume. Again, doesn't mean to buy it. Just because you see a lot of open interest and a lot of volume doesn't mean you buy it. It's just something to be aware of. It's very important. You want to trade highly liquid options. You look at strike prices down here. So basically, the deeper these gray or this purple area, remember, in the money, more expensive because why? The odds are in your favor for you to succeed on the trade. The black areas are much cheaper because you can see the odds of you succeeding on that trade are very slim. This is, again, as an options buyer. Going back over to the put side again, you'll see put side in the money goes down this way because price is above. You can put the price to somebody else, right? So you're buying low over here. You can exercise your options contract. Let's say if you're in Apple at $95, you could exercise your options contract and own 100 shares of Apple at $95. So that's where the exercise process comes in. You're buying lower, which means you could own, if you don't want to buy and sell an options contract and you have the money and you have a bigger size account, this is controlling 100 shares of Apple. So if Apple goes in the money and it goes in your favor and you want to own shares of Apple, you can exercise that options contract and own 100 shares of Apple times $95, right? And you can, if you have the money in your account, you could be owning Apple at $95 and Apple could be whatever at 120 or 130 bucks. So that means you obviously bought Apple lower. So again, people buy and sell options contracts, but if you have a larger size account and you actually want to own shares of larger companies, that's how you would exercise the options contract and own the actual shares. So that's on the call side. On the put side, it's just reverse. You could put it at a higher price to somebody else, right? That's why you're paying more for these options contracts over here because this is above price. So if Apple falls, again, you don't just randomly buy this. If you believe Apple's going to fall and it falls down to 100, and you can see you're paying higher over here in the money side. So you can see you can put Apple to somebody else at a higher price. Again, this is if you're going to exercise the options contract. If you have a smaller account, less than 20, 25,000, remember, you're not going to own 100 shares of Apple unless you have, what is that? $10,000-$15,000 in your account. So, or more. So typically you're going to just buy and sell the options contract, but that's how it works with exercising. You can put Apple to somebody else at a higher price and keep the difference, or you can exercise right here on the call side. You can buy and hold and have price lower. But this is, where you would, again, calls mean you believe the price is going up, puts mean you believe the price is going down. And this is how you can make money in up or down markets. So instead of shorting, you would go over to the put side. But again, you can see over here, in the money over here, the more expensive because, again, much further away from price. And as you can see, as price goes down here, your probability of in the money, it decreases down here, so the odds are less in your favor, and that's why the options contracts are cheaper. So again, this is more of a highlighted video overview on an options chain, what to look for. Just kind of get it, if you're new to options, just remember, just because something is cheaper doesn't mean it's better. It's cheaper for a reason. It means that you're way less likely to succeed on that trade. And that's why you have to understand and learn why you would, when you become an options buyer of, let's say, calls and puts, compared to an options seller, or where you go into the world of spreads, where you do a combination of buying and selling calls and puts, and creating strategies like debit spreads, credit spreads. So again, we teach that stuff in our courses. This is more of a high-level overview of what to look for, being aware of your odds of success when taking an options trade, being aware that options expire, knowing that you want to take action before that expiration date. Again, so hopefully this video helped you, and make sure you take our courses if you need more help with trading options. Enjoy.